Welcome to Everything Money. Today we're talking about Hershey chocolate. Paul, this is my vice. I'm trying to lose weight. I'm on a weight loss challenge with you. You've challenged me to lose 40 pounds this year and I'm down 22. But Mo, when I see just a simple Hershey almond bar,
it's game over.
It's like I'm like doing a doing a Tootsie in the parking lot, like Wolf of Wall Street. I can't get enough of it, Mo.
Have you ever been to the Hershey factory out there? And
look at me, Mo.
Have you? I've never been. I want to go.
Well, it's for kids, but it's got the whole tour and it's got the you can just buy all this bonkers candy. It's got the ride.
Do you have like the big Hershey kiss?
Yeah,
that's what I want.
The kids love it, but we're
Does
talking about. We want to separate her.
Chocolate?
Oh, does it smell like chocolate, Paul? You'll be your new cologne.
Seriously, so Hershey, Pennsylvania smells like chocolate.
We're going right now. That's our show. We'll see a fondle thumbs up on the way out. We're leaving to go to Hershey. No, we're not. What we're actually going to do is take a look at the financials of this gorgeous company that makes all the beautiful Reese cups and Reese pieces, Mo, and then the ticker price. Are they in line? We need to separate the company from the stock price and learn, is it justified? Is it overvalued, undervalued? We will do all of this right now using our beautiful 8-pillar analysis, Paul. And this is Paul Gabriel and Trader Mo. I love you. Let's get after it. Hershey's.
So guys, first off, follow us on Instagram so that way when we do go to Hershey,
yes,
you can see all of our posts and stories about me inhaling chocolate. And at some point, we're going to have I love Hershey Kisses. Like literally that I think is although since I'm losing weight as well.
Go on.
I haven't had sweets in a while, and I haven't had the desire to have them because I just pass them up now, and I'm like.
But when Christmas hits and those little sugar cookies with the
by then I'll weigh like 30 pounds less, so I won't worry about it. No,
Go ahead. What is the market cap of Hershey?
All right, guys. So Hershey is a $36 billion company.
Incredible.
Okay, 5-year PE of 33.25. That's an X. We want it less than 22.5.
Okay.
But healthy gross margin and healthy profit margin. Very good 5-year return on invested capital, 17.3%. That's a check mark. We want it at 9%. This means they do a good job of investing their capital, their debt, and their equity back into the business to generate more profit, okay? Now, 1.8% dividend pays out $650 million a year.
Cute.
So we want to make sure can they afford that? Their 5-year average free cash flow is $1.25 billion, so it's a little over half of their last 5 years of free cash flow, but their last year was 1.6, so they can easily afford this dividend. Great start so far, except for the valuation, right? So my initial reaction is, might be expensive, but might be something we want to keep track of because, who's competing with Hershey? This is the moat that Warren Buffett talks about. How are you going to create, if you, as Warren Buffett would say, I'll give you $10 billion, go create a chocolate company that competes with Hershey tomorrow. Are you going to be able to do it?
Ain't happening.
It's going to be very difficult. So that's a moat that Warren Buffett talks about.
Sadly, when you learn that 90% of the people who touch the chocolate that ends up in a chocolate bar, or at least the process, they've never even had a piece of chocolate. These poor folks in Africa that are getting these beans out. I'm just bringing the whole damn show down, but that's really sad. Is a lot of the people.
I'm gonna go kill myself now.
Seriously, just keep eating that chocolate, Paul.
Okay, so
revenue growth over the past 5 years.
7.5 to 8.7. Check mark there. Very consistent and slow revenue growth.
Most of that revenue is coming from me, but keep going. Go ahead, Paul.
So guys, remember, remember, this is a slow growth company. You can't pay a premium for slow growth. That can't be your only reason to pay. People sit there and say, oh, it's Hershey. Now, is there an argument to be made? It's Hershey. They have the moat. It's hard for people to compete with them. Yes, pay a premium for that. But there's very little revenue growth here. Just keep that in mind as you're going.
Profit growth is pillar number 4, Paul.
We have $672 million to $1.44 billion. Chitty check right there.
Shares outstanding, Paul?
Okay, $213 million down to $206. So guys, they're buying shares back. They're rewarding their investors over time by buying more and more shares back, decreasing the number of shares outstanding, giving you, the investor, more ownership of the company just by holding your shares that you currently own.
Perhaps this is the first time you've ever looked at a stock in this fashion, looking at the financials. I used to never do this, and so when Paul showed me this, I was drawn to it. You can have this software. You can look at your personal investments right now by joining us at everythingmoney.com. Join our community, either Everything Money or Patreon. You get access to our Discord channel of over 5,000 people discussing stocks like Hershey, whether it's a buy, and you can trade with Mo in the Bidness Nation, Paul. Tell us what else they get. I don't know why I'm so excited.
So guys, everything you saw in the software and everything you see is available. Well, you'll get with your software, but you also get it in the mobile app. You get the 8 pillars, 30 years of financial data, the stock analyzer tool, daily content, 1 to 2 videos a day we'll be providing for all of our Patreon, our users on the software, all these other things. But the biggest thing, Discord community, over 5,500 people on there discussing investments, whether it's stocks, ETFs, real estate, crypto. We don't judge. They're all doing it in an organized fashion. And guys, all of this for 87 cents per day. Less than a crappy cup of coffee. If your future financially isn't worth 87 cents a day, I don't know what is, especially with our competitors, $200, $235 a month, and they don't even provide everything. This is a no-brainer. Click the link below, sign up, and it'll be a game changer for you.
Pillar number 6 is total long-term liabilities, basically their debt, divided by their 5-year free cash flow. And we want this number under 5. Explain it, Paul.
So companies that have less debt are more likely to survive, right? So what we want to do is we want to take their average 5-year free cash flow and see, can they pay off their debt in less than 5 years? So we take the 5-year free cash flow of $1.25 billion, multiplied by 5 years, and that equals $6.25 billion, right? So we want their total long-term liabilities under $6.25 billion. So we go to the balance sheet, we go to the bottom, total long-term liabilities, $5 billion, we're good there, right? So they're currently about 4 times their 5-year free cash flow. So it's a check mark there. And then let's go to the free cash flow to show it, even though we've already discussed it. But our handy chart over here, our handy cash flow statement, actually does the math for you. This is not on any other financial website. $730 million to $1.6 billion, check mark. And I love the consistent growth. Just the consistent growth of free cash. Guys, if you paid a reasonable amount of money for a company and this is there forever, you're going to make a lot of money. It's just going to keep building the free cash flow, keep building it. Average of 1.25. We multiply by 20 as a starting point, and we have a $25 billion market cap.
The actual market cap is 36 bill.
So that's saying an X. And guys, if you look at our 8 pillars, what were the expensive part? What were the bad parts of the 8 pillars? It was all checks except for valuation. This is our major indication. This is a company we want to own, but not at this price. So what we're going to do is, after Mo's done doing the charts, we are going to go do the stock analyzer tool, which is included in the software. It'll tell you exactly what you've paid for the company based on your assumptions.
Let's head over to Mo and see if people are trading Hershey. I can't imagine the volume is too hot to trot here, Mo.
Well, let's see. I haven't looked. I'm just going to assume it's low. Yeah, I mean, the average volume is probably 700,000 shares traded per day. But I would be comfortable trading something like Hershey. You're not going to get a bunch of hype people coming in and spiking that stock one way or the other. Now, this is a good example of when we turn into a downtrend, meaning dropping into the sweet spot in the opposite direction. This is why I want 3 days of confirmation, because the first day we were in a downtrend. Second day looked pretty good. Third day, what I would have wanted to see was an engulfing candlestick down, and we didn't get that. And now we're just pretty much sitting neutral. So what I would like to see is this yellow line getting into the sweet spot, followed by the red leading, and then start making real engulfing candlesticks down. Give me a confirmation that this is actually going to be a downtrend. It's very possible that this red trend line goes right back up, because if you zoom out here over the past year, I mean, look how long that long-term trend lasted. It's going to take a lot to break that. So this thing can easily pop back up and just keep going sideways. So we need confirmation with those engulfing candlesticks coming down.
If trading sounds sexy to you, you can join everythingmoney.com, join the Bid and Ask. You'll be automatically entered in our second Tesla giveaway, which will happen around Thanksgiving. And let's see what we should be paying for this. That's right. It's currently $174. We've sort of determined this is too high.
Yeah, because we loved all 8 pillars except for the 2. We loved 6 of the 8 pillars. The 2 that were bad were the valuation ones. So, revenue growth. These are the revenue growth numbers of the last 1, 5, and 10 years. Again, my job is to be conservative. I put 2, 3, and 4%. Share buybacks, I put -0.5, -0.75, -1. Profit margin, I put 11, 12, 13. Free cash flow margin, 12, 13, 14. Now guys, PE. Their PE is 33 and 22. 12 for the free cash flow, 12, 14, 16. There's no growth here. Why would I be paying a premium for it? Returns, 15, 12 and a half, 10. Hit the analyze button. It's just gonna tell me, Paul, you need to pay between 65 and 70 bucks a share, but it makes sense based on this PE. This PE's got to fall by at least half. So maybe you're going to pay. Maybe it's probably worth around 100. But again, as a value investor, you want to pay less than it's worth. But for a company like this, Hershey, big brand, moat, you might want to pay closer to 100 for the stock if it falls that low.
Even in the depths of COVID, it fell to 111. But prior to that, April 2019, we're talking about a $100 stock. So it's been around $100 for a long time.
I know, and people say, Paul, it's not going to drop. Guys, just look at the history of all investments. They all go in and out of love. You've got to be the person who sees the stock fall in half and go, nope, it's Hershey, I'm still buying it. Add this to your watch list, which is coming soon on the software. That way you can be notified when it hits the price you want it to hit.
Follow us on Instagram. Fondle the thumbs up on the way out, and we'll see you on our live stream. Mo goes live every morning, 9 a.m. to talk news and notes and stock trading. And we go live to all of you 2 p.m. Eastern on Tuesdays. We'll see you there. Tickle the thumbs up, and we'll see you on the Discord chat. Message me on that Discord chat. I love you. See you guys.